Inflation is the upward price movement of goods and services. It can erode the purchasing power of consumers, as a single dollar buys less over time. It can also affect consumer confidence and spending habits, as people may change their consumption patterns or worry about their budgets. Consumer spending is a critical component of inflation, as it reflects the demand and supply of goods and services. When consumers spend more, they create more demand for goods and services, which can push up prices. When consumers spend less, they create less demand, which can lower prices. However, consumer spending is also influenced by various factors, such as labor market conditions, production and shipping costs, stimulus packages, and expectations about future inflation. These factors can create different effects on consumer spending depending on the type and duration of inflation. For example, if inflation is temporary and driven by supply shocks, such as the pandemic-related disruptions in global trade and production, consumers may expect prices to fall back to normal levels once the shocks subside. In this case, consumers may postpone some of their purchases until prices stabilize or decline. This can reduce consumer spending in the short term but increase it in the long term. On the other hand, if inflation is persistent and driven by demand shocks, such as the massive stimulus packages in global markets that boosted consumer incomes and savings during the pandemic, consumers may expect prices to keep rising in the future. In this case, consumers may advance some of their purchases to avoid paying higher prices later. This can increase consumer spending in the short term but reduce it in the long term. Moreover, if inflation is uneven and affects different sectors and products differently, consumers may switch their spending from more expensive items to cheaper ones. For instance, consumers may trade down to lower-priced products or own-brand items, eat more often at home instead of dining out, or shop at retailers that they perceive are doing better at managing prices. This can change the composition of consumer spending but not necessarily its overall level. In summary, inflation can have complex and varied impacts on consumer confidence and spending depending on its causes, duration, and distribution. Consumers may adjust their spending behaviors to cope with rising prices or to take advantage of lower prices. These adjustments can have implications for economic growth, income distribution, and business strategies. The current inflation crisis is one of the biggest threats to global prosperity in 2023. Inflation means a rise in prices across an economy, which reduces the purchasing power of money and can trigger a vicious cycle of higher wages and higher costs. But what are the main causes of this crisis and how can central banks address them? There are three main factors that have contributed to the surge in inflation in 2021 and 2022: fiscal and monetary policy, supply chain disruptions, and price gouging. First, fiscal and monetary policy. In response to the COVID-19 pandemic, governments around the world implemented massive stimulus programs to support households and businesses affected by lockdowns and social distancing measures. At the same time, central banks slashed interest rates to near zero and expanded their balance sheets by buying government bonds and other assets. These actions increased the amount of money in circulation and boosted aggregate demand in the economy. However, as the pandemic receded and vaccination rates increased, demand recovered faster than supply, creating a mismatch between what consumers wanted to buy and what producers could deliver. This put upward pressure on prices, especially for goods and services that were in short supply or had long delivery times. Second, supply chain disruptions. The global pandemic also caused severe problems for the movement of goods and people across borders. Travel restrictions, labor shortages, port congestion, container imbalances, raw material scarcity, and natural disasters all contributed to delays and bottlenecks in global trade. These disruptions affected a wide range of industries, from semiconductors to automobiles to furniture to clothing. As a result, many businesses faced higher costs of production and lower profit margins. Some of them passed on these costs to consumers by raising their prices. Others reduced their output or inventory levels, creating further shortages and driving up prices. Third, price gouging. Some economists have argued that another factor behind the inflation crisis is corporate greed or greedflation. They claim that some businesses have taken advantage of the high demand and low supply conditions to charge excessive prices and earn windfall profits. They point to examples such as gas stations, airlines, hotels, car rental companies, and online retailers that have increased their prices significantly above their pre-pandemic levels. These practices not only hurt consumers but also undermine trust and confidence in the market system. They also fuel inflation expectations, which can become self-fulfilling if consumers anticipate higher prices in the future and demand higher wages or spend more today. So how can central banks address these causes of inflation? Central banks have a primary mandate to ensure price stability in their economies. They do this by adjusting their policy interest rates, which influence the cost of borrowing and saving for households and businesses. By raising interest rates, central banks can reduce the amount of money available for spending and investing, thereby cooling down aggregate demand and easing inflationary pressures. However, raising interest rates also has negative consequences for economic growth and employment. Higher interest rates make it more expensive for businesses to borrow and invest, which can reduce output and jobs. Higher interest rates also increase the burden of debt servicing for governments, households, and corporations, which can increase financial stress and default risk. Therefore, central banks face a delicate balancing act between fighting inflation and supporting growth. They have to weigh the trade-offs between short-term pain and long-term gain. They also have to consider the sources and persistence of inflation. If inflation is driven by temporary factors that are expected to fade away over time, such as supply chain disruptions or base effects from low prices a year ago, then central banks may tolerate some overshooting of their inflation targets without raising interest rates too much or too quickly. However, if inflation is driven by more permanent factors that are likely to persist or worsen over time, such as fiscal expansion or structural changes in the economy, then central banks may have to act more aggressively and decisively to raise interest rates and restore credibility. In conclusion, the current inflation crisis is a complex phenomenon that has multiple causes and requires careful analysis and policy response from central banks. Central banks have to balance their dual objectives of price stability and economic growth while taking into account the uncertainty and volatility of the global risks landscape. Central banks use monetary policy to manage economic fluctuations and achieve price stability, which means that inflation is low and stable. Inflation is the general increase in the prices of goods and services over time. When inflation is high, the purchasing power of money declines and people's living standards suffer. To control inflation and stabilize the economy, central banks can use different monetary policy tools, such as open market operations, interest rates, reserve requirements, and foreign exchange interventions. Let's look at each of these tools and their benefits and challenges. Open market operations are the buying and selling of securities, such as government bonds, by the central bank in the open market. By doing so, the central bank can affect the supply of money and the short-term interest rates in the economy. For example, if the central bank wants to reduce inflation, it can sell bonds to reduce the money supply and raise the interest rates. This will make borrowing more expensive and discourage spending and investment. On the other hand, if the central bank wants to stimulate the economy, it can buy bonds to increase the money supply and lower the interest rates. This will make borrowing cheaper and encourage spending and investment. The benefits of open market operations are that they are flexible, quick, and effective in influencing the money market. The challenges are that they may not have a direct impact on longer-term interest rates or economic activity, and they may face operational difficulties or market distortions. Interest rates are another tool of monetary policy that central banks can use to control inflation and stabilize the economy. The most well-known interest rate is the Federal Funds Rate, FFR, in the United States, which is the rate at which banks lend to each other overnight. The central bank can influence this rate by setting a target range and using open market operations to keep it within that range. The FFR affects other interest rates in the economy, such as mortgage rates, car loan rates, and credit card rates. The benefits of interest rates are that they are transparent, easy to communicate, and widely understood by the public. The challenges are that they may have a lagged effect on inflation and economic activity, and they may face a lower bound problem when they approach zero or negative levels. Reserve requirements are another tool of monetary policy that central banks can use to control inflation and stabilize the economy. Reserve requirements are the amount of money that banks are required to keep in reserve at the end of each day. By changing this amount, the central bank can affect how much money banks can lend out and create in the economy. For example, if the central bank wants to reduce inflation, it can raise the reserve requirement to reduce the money supply and raise the interest rates. This will make lending more difficult and discourage spending and investment. On the other hand, if the central bank wants to stimulate the economy, it can lower the reserve requirement to increase the money supply and lower the interest rates. This will make lending easier and encourage spending and investment. The benefits of reserve requirements are that they are simple, direct, and powerful in influencing the money supply. The challenges are that they may be disruptive for banks' liquidity management and profitability, and they may have unintended consequences for financial stability or intermediation. Foreign exchange interventions are another tool of monetary policy that central banks can use to control inflation and stabilize the economy. Foreign exchange interventions are the buying and selling of foreign currencies by the central bank in the foreign exchange market. By doing so, the central bank can affect the exchange rate of its domestic currency against other currencies. For example, if the central bank wants to reduce inflation, it can sell its domestic currency and buy foreign currency to appreciate its exchange rate. This will make imports cheaper and exports more expensive, reducing domestic demand and inflationary pressures. On the other hand, if the central bank wants to stimulate the economy, it can buy its domestic currency and sell foreign currency to depreciate its exchange rate. This will make imports more expensive and exports cheaper, increasing domestic demand and economic growth. The benefits of foreign exchange interventions are that they can help maintain external competitiveness, balance of payment stability, and international reserves. The challenges are that they may be costly, ineffective, or counterproductive in a globalized and integrated financial market, and they may conflict with other policy objectives or international obligations.